All right, hello everyone. I hope that you are doing well. Welcome to this masterclass by Richthebull. Richthebull is by far one of the most intelligent and best traders out there at this moment. His executions are simply unmatched, the precision is insane, and he has been giving out the daily bias for about 2 months now, right, Rich?
Yeah, about that, mate. Yeah, I think
Man,
I'm
what's the look at now?
19-2. I think. Yeah. Oh,
Oh
sorry,
my god.
19-3. I'll say 19-3. Yeah,
Damn, 19 and 3. That's
yeah.
insane, bro.
It's not bad, mate.
Yeah, I
It's not
think
bad.
people are very excited for today's webinar. You're, of course, pretty active on the socials, but there's not much video content of you out there just yet, besides the OTK, of course. So this will be like an introduction, I think, for the majority of people to your voice and to the way that you internalize markets. So let's dive straight into it, bro.
Yeah. So what I was thinking was today was to show how we can use OTE to our advantage, and how we know that OTE is going to present itself more so than often. Because what it is, when people learn OTE, especially from ICT and a lot of other people online, nobody really explains how OTE really works and why. So the idea today is, I think some people learn better when they fully understand why something's happening, not just, oh, there's an expansion leg or there's a range, right? Pull a fib and then hopefully we'll get OTE. That's all anybody ever says. Nobody really explains the real reason for OTE. So if we look at yesterday's example, we had this big expansion leg, and now we have this big range. And if we simply pull the fib, we can see clearly OTE gets tagged. Now, we can use OTE as an entry, like ICT suggests, right? But what we can also do is we can use OTE as an actual target as well, or draw on liquidity as such. So we can enter here and aim for OTE. We don't just need to wait for OTE to form and then use OTE as an entry. I think a lot of people don't really understand that. So first, what I'm going to do is I'm going to explain just very quickly how this works, and basically the market makers, they know exactly how the algorithm works, right? We'll make this a bit thicker so everyone can see. Now, as we know, this is the leg. This is 50% of the leg, or equilibrium, right? The market makers, they hedge their positions. Every position they take, they hedge. So what they have to do is they have to offer sell positions and buy positions at the same time, right? So on this leg particularly here, as they sell, they are making money. But every time they've offered a buy position, okay, we'll do it visually. Every time they offer a buy position, that buy position is now in negative, right? And what they have to do is they have to keep offering them. So what happens is they just keep offering and offering buy positions, and they're constantly negative all the way down the leg, right? Well, then what happens is, as they get to the bottom and we start reversing, because the algorithm's programmed to go back to 50%, the market makers, they know that literally all they have to do is hold their positions until 50%. And not only will they squash all their negative positions, but they will also end up in profit by the time they hit this position. So here They've brought, right? Now, these 3 or 4 positions and these 3 positions cancel out all the losing positions all the way up here by the time we get to equilibrium. So as we know, price comes back to equilibrium, and now they're back in profit. This is why OT is so important, and people don't understand why. They just say, oh, pull a fib, wait for it to hit that level and we're done. That's not the case. Now, just so you do know, to hit 50% is actually, right, 50% of any leg. If you go through and back test, right, it's a 90% probability, right? So the reason this is good is because most people, they get greedy and they aim, right, for the other end of the range, which is fine if it aligns with order flow, right? But if you're wrong, this, even if your bias is correct, right, it'll only hit this target, right, 60 to 70% of the time. Equilibrium is 90% of the time. Now, if you're wrong, this is not going to get hit anyway, either way, right? But with OTE, if you're wrong, this is still going to hit 90% of the time. I hope you realise what we've just said to you there. This is golden information. So simple, right? Maybe for some of the intermediate to professional traders, they're already in the know, but this is how it works. So what I'm going to do now is I'm going to give you a live example so you can thoroughly understand what's going on, right? This is yesterday's price action. This is a brilliant example. We will go down to the 5 minutes. We'll rewind first, in fact, and we'll go down to the 5 minute, and we'll simulate exactly what I just said, right? So the market makers here, although they know we're going short now, right, they still have to, I can't show buy and sell positions with the rewind tool before anyone says like, oh, you know, why aren't you showing us buy and sells? So what I'm going to do is, obviously the sell positions, the market makers are winning money, right? They're making money. The buy positions, they're losing. But watch how it works, right? So they buy a position, right? Then they buy another position. Don't forget they're selling at the same time, but the sells that they do are winning because they're hedging, right? They buy again. They buy again. Now look, the negative, completely negative. What I'm going to do, I think I'll zoom in slightly just to make sure that it's very clear on the video. So as you can clearly see, the negative now, right? Which is not what they want. Excuse me. So we'll keep playing price. Okay, they keep adding, and the negative, clearly negative. So now we wait for that level to get broke before we start adding again. Bear with me, wait for news. Okay, so now news is gone, they're still buying, still negative. Then they buy again, they buy every swing. And as you can see now, they're back in profit. And guess what? This is going to be just past OTE. They only have to get to OTE to get back in the green, and this is how it works, and this is why OTE is so important, and this is how it truly works. So the market makers, they know that price is going to come back to 50% no matter what, at least 50%. And that, guys, is a 90% probability, just so you do know. Right. So, how do we take advantage of this? I'll show you right now. We'll get rid of that. Like I said before, we can use OTE not only as an entry, okay, but also as a target. So if we took this liquidity purge down here, this is at night time, obviously Asia session, so for the people trading New York session or London, that would not appeal to them, but it's still a possibility. We could enter right down here and we could hold all the way to OTE, and then we could start looking for a reversal after OTE. Same with the news. News candle comes down, takes all liquidity on sell side, comes back up, retests the midnight open, the true open, and then goes straight to OTE. Okay. Another interesting fact, which you can go and back test, is look what happens here. Consolidation. Consolidation always happens at equilibrium. Okay. Now, some of you are going to say, okay, now you need to pull like ICT's fib with the 70.5 measuring tool to try and find this reversal. Or you're going to ask me, Rich, you know, how do I know that it's going to reverse there, right? So what we do, firstly, as we all know, we're going to check the time. So we're going to see where we are in time, okay? If we're at a specific time, if we've got SMT, if we've got a market structure shift, right, what you can do is this hack, right? What nobody teaches anywhere. And that is all ranges are fractal, right? And what I'm going to show you now is actually a game changer to check your idea, right? And it's as simple as this. You fractalize the range to find the entry. So you think this first reversal here, or what looks like to be a reversal with CSD, could be the move, okay? What you simply do is this. You just fractalize the range, right? And you fractalize it again. Okay, now you can see we're over 50%, but then watch what happens, right? This happens over and over and over again. Look at the accuracy in that. So now we fractalize the range and you can see exactly where the reversal should be. Now there's a little bit of source for you. I'll leave that with you guys to back test. I'm not going to go any deeper into that right now. So, more proof of OTE and how it works is simply this, right? ICT, when he was explaining about discount and premium, was very overlooked, okay? And even with your entry, we'll call them patterns, okay? Entry patterns or entry models, you can use OTE, right? And if you look, if we measure this expansion leg, look at the entry. The entry is exactly OTE. And for those of you that just say, oh well, that's just lucky that I picked that one, well, in exactly the same trade, there's another one right there. We hit OTE, price goes up, expands, comes back down. Like ICT says, we need to go down before we go up, or we need to go up before we go down. And this always happens. They always reprice to take profits here because of the positions, because here the market makers will be sell, and they'll be well in debt. They know that the algorithm is going to come back for them, so when they sell, they're back in profit again, ready for the next move. And this is all price does day in, day out. backwards and forwards, giving the market makers chance to either A, break even, which is unlikely, or to make a certain percentage of profit on top of the losses, the initial losses. And I think that'll do for OTE. I'll let you guys go off, back test that, and see what you think. I think they'll find that interesting, Zeus.
Yeah, I think so as well. I wonder, Rich, when it comes to OTE and when it comes to ranges, you always had this saying that price will always go to equilibrium, and that if you know that the opposite side of the range gets taken out, you can anticipate price to drop back to equilibrium. How do you utilize that? How do you utilize that information?
Say that again. What do you mean? Like, repeat the question, mate. Sorry.
Well, for example, your trade on this day,
Yeah.
on the afternoon session, you went short at the exact top.
Yes.
Why did you go short there?
Well, exactly why I was saying. So we're anticipating straight away, right? My order flow is bearish at the moment for this day, right? So I'm anticipating. We've got the range. We already anticipate what's going to happen once we've got the range. So there's OTE, and I'm looking for reactions after the equilibrium. So basically, I'm looking at time, right? We hit equilibrium at 11:40. So now I'm not interested in anything until after 12. So basically, this is 11:40 when we hit the equilibrium. I'm waiting till after 12, so I will put a timeline in for 12, which is there. And now I'm looking for an open high on this next candle to go short, which we get. So basically, using the power of 3, we get open high, and then exactly like I told you, we get this first little fake market structure shift, or CSD, if we zoom in so you can see it clearly, right? We get this first little move here. Now I don't like this because yes, we have a breaker here on a lower time frame, but we don't have a clear breaker in this price action, right? So I'm waiting. So now I'm anticipating that this move is the breaker. Okay, then like I just said before, what I will be doing is, behind the scenes, while this is panning out, I'm fractalizing this range, right? I'm then fractalizing this range. We see that we go over, and then over the equilibrium of this fractal range, and then we come back under. I know I haven't got a breaker, and I know that this is going to possibly be the breaker. We're at a perfect time. We're 12 o'clock. We opened high. I'm waiting for a flip of this candle's open. This candle's open was here. Make it red. And I'm waiting for a flip of this open, right? While I'm waiting for the flip of the open, I'm constantly fractalizing the range. And as soon as this happens, I know. As soon as we fractalize the range, the candles don't close above this level. We close below. And then we displace, okay, underneath the candles open. And the candles open, as you know, Zeus, and you teach well in TOTK, the open of anything is the true CSD, whether that be a 1 minute candle, a 1 hour candle, a day candle, a week candle, a year candle. The open is the true CSD. Then we get the touchback, we've got the breaker, we've got the unicorn model, right? And then price falls away nicely. Now, even if my bias is wrong, which I'm not overly concerned about, we're still going to get presented with a nice move. I'm pretty sure this was around 10 handles, if I remember, where I took profit on my futures account. Yeah, and it went 26 handles to the very low, which was nice. So that's how I would anticipate the entry, Zeus. I would fractalize the range. I would look at time, okay, and I would use the open high of this particular candle to go short, and that's exactly how I would do it.
That's lovely, man. A few weeks ago, I believe it was not last week but the week prior, I made a post on Twitter with regards to the following. You can trade ICT concepts without utilizing PD arrays. And you just showed how.
Yes, mate. I'm a big believer in that myself. Look, it doesn't matter how people perceive the market. The fact of the matter is that this is all 100% algorithmic. And although some people don't believe that, we prove this day in, day out, repeating, just doing the same thing, following the same logic. And if we look at these, let me clean this up a little bit. If we look, in fact, I can leave it open. I'm going to move these. If we look at time and we look at the range, because these are the most important things in my opinion. Time, price, and range. When we look at the range, we can clearly see this is an algorithmic delivery, 100%, because the open, like, and it's not random, is exactly at this area here, right? The same area where the BISI, the SIBI, and the breaker all form, right? So ICT, as you've rightly said, he points out the PD arrays, right? But these PD arrays are forming because of algorithmic signatures, basically. It's proven, we've proven it day in, day out. There's more going on. And in this area here, price is telling us that now we're going to change from a buy program, once this happens, into a sell program. That's a fact. And yes, we do not need PD arrays. I 100% believe that. I use it on a daily basis, mate.
That's a lovely answer, man. I think that many people can definitely look into that, because I feel that within the ICT community, this narrative has been created where it's just, oh, it's a unicorn, oh, it's a breaker, plus fair value gap, oh, it's this, oh, it's that. And by creating that narrative, there's now the issue that many people are simply looking for price patterns. They don't understand the narrative of looking at, for example, opening prices, the timings at which markets reverse, the signatures that are present that confirm reversals with regards to ranges, intermarket relationship, etc. So I think that what you just described is already something that people can look into greatly. Do you think you could maybe show another example of this?
Yeah, mate. Well, just to reiterate on what you just said, like for me, and no doubt for you and a couple of other people, there's only a handful of people that I ever talk about, in the game. For us, it's very irritating when all we hear is these other educators, and all they ever do is they parrot the same conversations with everything. Somebody will say, why did this happen? They'll say, oh, break a fair value gap. You say, oh, why did you enter there? Oh, break a fair value gap. And that's all you ever hear. Oh yeah, it was a break a fair value. Oh, it's an inversion. Is it inversion fair value gap? Not digging at anybody particular. Oh, it's a break, it's a fair value gap, and that's all we ever hear. Break a fair value gap, break a fair value gap, inversion, break a fair value gap, and it's wrong. It's absolutely wrong, mate. It's crazy. Yeah, there's plenty. What example do you want, mate? What of an algorithmic signature like this, or?
Yeah, let's just go to another day and just see a trade that you took and maybe get like a saucy breakdown from the man himself.
Yeah, no problem, mate.
I think many people would appreciate that.
No problem. This was slightly different. So, if you look here, the breaker. So for some people, everybody's trying to like take the soup now and get in here, but for some of the very beginners, I wouldn't advise trying to take CSD entries, right? This is the 5-minute chart, by the way, so this is quite clear. You won't get in as early, but it's very safe. Okay, so here exactly the same thing happens as what I've just showed you, right? This is over a slightly bigger time range. Okay, notice how I said time range. So we have the breaker here, and if you look clearly, right, we're inside this BISI. As Zeus teaches in his lectures, right, this means that this is the intermediate term low because it formed inside this BISI. Okay, but what we do like is when the breaker, right, is the intermediate term low. This is a stronger signature, right? And yes, there is different types of signatures, there is different strengths of signatures. Okay, for example, this one, when we try and pull this BISI through, okay, it's not in line with the SIBI, but it doesn't matter because if you know what you're doing, these wicks, okay, where these overlap, this is no different than a gap. So where this wick and this wick overlap again here, where you'll see the darker patch now. Oh no, you can't see. Let me make this lighter. Bear with me, guys. I moved this the other day. Okay, can you still see that, Zeus, on the recording? Is this too light now?
No, it's perfect.
Okay, I'll go a little bit darker. Okay, so where these two wicks overlap here, this is no different than a gap. Okay, so now what do we have? We have what we call nested PD arrays. And if you look where the very darkest patch is in that price action, okay, this here is like a balanced price range. Price should never come back to this area again, or it will retest. So all you do, you wait for the next candle to open. When it opens high, you enter anywhere in the wick. Now, the reason that's happening is because, again, this is an algorithmic signature that once price passes this area, okay, it's time to go. And if you look on this side, yes, we did have a very lower time frame breaker here, okay, but it's not significant. We do make quite a big move up. Then when we come back down, we can anticipate already. So what you guys need to do is, when you're watching price, when people say reading price, what you don't realize is when you read price, you need to watch the candles come down and anticipate this breaker to be made. Okay, so you could think it was this one at first, right? But as you see, price never displaces higher, comes back down, makes this breaker, then we displace. Okay, we displace higher. Now, when we super this high and reject, okay, we have this same signature, what I've been talking about. Okay, and when all this is aligned, this level here will not get broken until the draw on liquidity is met. So even if price wanted to go higher, right, even if it did, we have to wait for price to hit the target before going higher again. That's the only way it can happen. Price cannot reverse and it cannot switch, right, from a buy program to a sell program or vice versa until the draw on liquidity is hit. That's why sometimes you guys see me having a stop loss here, right, and then even when price comes down to here, comes all the way back up, I'm not scared, I hold it and I let price go again, because price cannot go into a buy program and take this high. This is a protected high until the draw on liquidity is hit lower. And these are all to do with the algorithm, all algorithmic signatures. And this is another perfect model of that right there. So for those of you, I'll reiterate quickly, you would see this forming, okay, this is the intermediate term low, breaker inside a fair value gap, perfect. Then we don't get a fair value gap here, because what we would like to see is this BISI closed by a BISI, and it didn't happen here, it happened slightly lower down. Okay, so this BISI was closed below, which would also give you the chance to re-enter again. As soon as this BISI was closed by this SIBI, closed past it there, you could re-enter there again. But for me, as soon as I see this breaker, okay, and I see this immediate rebalance scenario happening, as soon as this candle comes up, I can enter there. If I want to be secure, we can use the overlap here, which is just the same as another gap. Okay, and we can enter on the very next candle, either on the open or if it wicks up into this area. But either way, you can clearly put your stop loss here, and it will be safe. Another example, Zeus? Or was that okay?
Yeah, let's keep on going.
Yeah,
I think many people that started watching this masterclass probably were like, oh, he goes on about OTEs. Oh, it's just OTEs. Oh, it's just, this price pattern, my ICT, dealing ranges, whatever. And some of them might have clicked off and they're all missing out on the sauce now.
Yeah, but the thing is, mate, this is what people don't get. Like, the average, like, look, and I know I've not been trading long, and yes, I've been very well trained, but education is key, and a lot of these educators out there, all they do is constantly repeat what ICT is saying, and I'm not saying that's wrong, because listen, ICT, as we know, is the man, right? He is the creator of 90% of what we know today. But ICT is very smart. He doesn't let the lazy learn. Okay, he makes people fight for the knowledge. So unless you really are prepared to dig deep, you're never going to find this information. And although some people complain about paying for discords, paying for mentorships and things like this, listen, for some people, if they don't have some kind of a mentor or somebody to look up to, they're never ever going to find this information, because they're blinded by all the idiots, and it sounds stupid, giving away the free information that's not real information. So it's something for people to think about. They really need to understand what's really going on.
Yeah, of course. Yeah, I think it's also the way that ICT has structured everything that's just genius, where he just literally rented for like whole lectures, and then towards the end of the lecture just drop some very big sauce, and it's not for the lazy.
Yeah, listen, mate, you know as well as I do. Basically, you'll do a 3-hour video, and there'll be 3 minutes of very, very important high level knowledge that gets spilled through that video. And if you don't sit and listen, because like I said, ICT, he's got a only the strong survive mentality, and that's why, like you say, he's very smart. He structures it the way he does, because he doesn't like the lazy people no more than anybody else, mate. And I think he just thinks, well, if they're not going to learn, then they're going to be losers. That's it. You either learn or you lose. It's that simple.
Yeah, sick, man.
Yeah.
That's exactly how I view that as well.
Yeah. I do think that's the way he thinks, mate. I'll be honest.
Let's go to the next example, bro.
Right, so if I remember rightly, we have something. Yes, I think so. Let me just double check. Okay, perfect. So what happens is, in this example here, this one's a little bit messy, but I'm just going to showcase something to you now, which again, most people, and this is very simple, by the way, guys, but some people just miss the point, right? So here in this example, we don't quite have the fair value gap to the left, okay? So, but most people would see this scenario, right, and they would see this, what most would call mitigation block. I hate that word in trading. And most people will either A, not take it, or not really trust it. But what they failed to see was it's the same algorithmic signature as we've just been using, okay? And I reiterate, this isn't a real unicorn model like everybody says. A breaker and a fair value gap is not a unicorn model, and it is not a real unicorn, and it's not the unicorn that ICT teaches. And if your educator or anyone else you see on social media is telling you that, they are very, very incorrect, okay? Just so you know. Now, for those of you that get a little bit thrown off by these mitigation blocks, watch, I'm going to give you a very simple explanation for this. I would take this trade, okay? Yes, we can say that this one is a breaker here on a lower time frame. We have a low, a high, a low, a low, a high, a high. But I prefer to use the bigger structures which are more highly probable, okay? So when we look at this one and we're looking at it on like a 15-minute or a 30-second chart, it's not as highly probable as this bigger move and this bigger candle, right? This bigger candle is significant for a reason, okay? Now, here's the trick, right? We have a mitigation block, but we can enter like it's exactly a breaker, right? Why? Okay, it's very simply SMT, because on one asset this is a mitigation block, and on another asset it's a breaker. So if we look here on NQ, it's a breaker because we have a lower low forming here, okay? The low did get taken on Nasdaq because Nasdaq did not have the protected low. ES had the protected low, okay? And that's something we can learn about later, okay? So there is ways to know which lows won't get taken again and which ones will. In this case, it was ES, right? ES was the protected low. But what I'm trying to prove here is that because this is what, you know, most of the educators call a mitigation block, for me, it's not a mitigation block. It's still a breaker, because when you've got SMT, right, it's a breaker on other assets, which means it can also be used as a breaker on this asset when this asset has the protected low. I think that will give people something to go and figure out, Zeus.
Yeah, to think about. I wonder, could you please share some info on protected lows?
You want me to go into that right now?
Yeah, why not?
Okay, so
I think it's very important for people to begin to understand.
well, I like to keep that one for myself. Yeah, of course. So protected lows are mainly down to SMT, right? So are we giving the source with breakaway gaps as well, or are we leaving that one for another time? Same scenario.
Maybe just introduce it a bit.
Okay, so look, the majority of these things, the majority of these things happen because of a break in correlation. Okay, so it's as simple as this: if we have one asset that makes a lower low, and then we have another asset that makes a swing, a failure swing, okay, then we have the other asset will then sorry guys, wait there. The other asset makes a lower low. Now everybody gets this confused, right? And I'm going to tell you how it is right now, and this is unarguable, right? There's no arguing with me over this one. So anybody that wants to say different, like, there's just no arguing, right? The asset that soups the low is the weaker asset, right? It's the weaker asset. The one that doesn't take the low is the stronger asset. Okay, there's a lot of confusion about this online. Loads of people get this mixed up. Now, we know that the markets, right? The markets do not have buying and selling pressure. Okay, so we don't have buying and selling pressure. This isn't people buying to make the market go up. This isn't people selling to make the market go down. The algorithm is pre-programmed. It's going to do no matter what it's going to do anyway. And what I mean by that is, if everybody went on social media tomorrow and said, right, let's go on S&P and let's all sell, everybody in the world, let's sell, and we'll just bump, we'll completely wreck the market. Yeah, we'll crash S&P, right? As ICT said, millions of people got together on Reddit years ago. They tried it, and ICT was sat there laughing because everybody sold and the market went up. Because the algorithm is programmed to go down, up, no matter what you're doing behind the scenes, whether you're buying or selling. So if everybody in the world got on social media tomorrow and said, right, let's sell off the S&P and we'll crash the market, right? What will happen? You'll all lose your money by the time this leg comes. It's that simple, right? But the way I will explain this to you is that way, for simple logic. So what this means is, right, as we'll mark this out so you can see. So if we said that this was ES, okay, and we said that this was NQ, right? So what would happen is, as price is coming down, there's more need, okay, for a buy program. In other words, yes, I'm going to say it, although we don't like saying it, there would be more buyers involved if you wanted to look at it that way. So more buyers involved, right, or a more need to buy to send the asset up. That means that this failed to take the low. That doesn't mean it's weaker, it means it's stronger, right? When this asset takes the low, it's because there's more need for sells, or if you wanted to look at it the other way, more people are selling than buying. So that means more people are buying this asset than they are this asset. So this asset fails, right? All you've got to remember is the one that soups is the weaker asset, and what you want to do is get involved in this failure swing, okay? And inside this failure swing, there will be another turtle soup. Go and investigate. So the protected low is this low right here on ES, right? We can use multiple confirmations. I'm definitely not going into that right now because that is some serious source. That can be done later, but basically we can set our stop here, okay, at the protected low, and this stop will not get taken, guaranteed. That's why sometimes you see me with no stop loss. I do not advise anybody to trade without a stop loss at all, okay? It's only because I'm sat manually watching the trade and I've got my finger on the mouse and I'm ready to click the stop button at any time. But what I do want you to understand is this, for example, right, if I got it wrong, right, if I got the bias wrong, this stop could still not be taken until this high was hit. So once this high was hit, then I would have to take caution, because there is a possibility that if my bias was incorrect, price could come back down and take this stop. But at this point right now, right here from this failure swing, and we proved this failure swing, this failure swing cannot dig down again a second time. And there is some other tricks we can use with power of 3, okay, for this scenario when you get this second dig. Also, this is the same with breakaway gaps, okay. I would go and investigate. It has something to do with SMT. Go and have a look.
I wonder, Rich, could you maybe now include the opening price logic into this example?
What for this?
Yeah, basically to determine the CSD, that price is gonna run higher without taking note that go.
Okay, shall I go into the power of 3 scenario then and show?
Yeah, sure. It's exactly the same, of course.
Yeah, because we get, like, I know what you're saying, mate. Like on social media, we get questions all the time. People saying, "Look," so this is one reason why this low doesn't get taken, but there is another, more simpler version of this, and it's to do with power of 3. So what happens is, some people, even if they get this wrong, they put the stop loss there, right, and then then we get that second dig down, and this really irritates people. And there's something very simple and very logical, which again nobody teaches, and nobody ever explains it properly. I don't think I've ever seen it explained properly. We can go into that right now if you want. So let me get rid of some of these drawings. There was a trade that I took the other day that we can look at. Let's get rid of those.
Yeah, I think the third would be a perfect example for you.
Yeah. So, what? Yeah, this was the third. So, I had loads of questions about this as well. So this will be a good scenario. I'll rewind this just so it's a little bit easier. So, what happens is a lot of the time, we get this scenario. Okay, Asia gets swept here. Asia and London get swept. Right, the lows. Now, the 8 o'clock candle is the candle that swept the low. So what people do is, obviously, as we know, most professionals, we like to get in on the wick. So everybody is trying to bottom tip this right there. Hope you can see that clearly. Everybody's trying to tick this wick here, right? And I don't care who you are, I don't care how good you are, there's going to be a lot of people out there that made this mistake, and they took this turtle soup here and then got stopped out by the 9 o'clock candle. Okay, and the simple logic behind this is, what most people miss is, this candle opened high. Okay, so what we'll do, we'll make this simple for some of the beginners. Obviously the intermediate guys, you will know exactly what I'm talking about. Bear with me.
Please mind Rich, he's not the best designer behind tech.
Here we go. I knew that was coming. Right, so I might not be the best on... Listen, I'm going to say something now. Anyone that's good on computers is not a good trader, because I've noticed that everybody who's crap on a computer is a very good trader. So I just thought I'd put that out there. That'll cause some controversy on the social media. Let's see what that brings. Okay, so this candle opens. This is the 8 o'clock candle, right? This candle opens. Ignore the wick for now. I've just drawn it on for now. Okay. The candle opens, and then what it does, it starts to gyrate high. Okay, so this candle has opened high, right? So when it opens high, we wait to see what it's going to do, right? And yes, it soups these highs, these relative equal highs, okay, and then makes its way down. But the point that I'm getting at is, once this candle's opened and it flips the open, right? So once it's gone from this side, so it's gone high and it flips the open again, this is CSD, we're expecting this candle to then go short, right? But if you notice, this candle, when it's being made, right, and we're watching price, the candle gyrates like this, okay, and it goes lower and lower and lower, but it doesn't just go down like that. That's not how it works. It has to gyrate, so it gyrates like this and it builds the candle, right, before protracting and making a lower wick. Now, the reason most people get stopped out here is not just because of time, but because of how this candle was made, right? So if you entered here, right, so you enter here, because this is a down candle, because it opened high, right, there's nothing to say that this candle is not going to keep gyrating and going down and down and down and taking you out. Okay, now the worst scenario is if the next candle was also an open high candle, you would not certainly even think about taking a turtle soup. For me, because this candle opened high, I don't take this turtle soup. Okay, for this reason, because the next candle opens low. Right, now if you're going long, you only enter on a candle that opens low, whether that be the hourly, the 15-minute, or whatsoever, right? So then this next candle opens here, Okay, and then the first thing it does is gyrates down. Okay, so it gyrates down to make the wick. So it gyrates down. As soon as this has gone down so far, it comes back up. It flips the open, and then gyrates up higher. And the next candle also is the expansion candle, because we have accumulation, manipulation, distribution. Okay, we're going to look at this on a lower time frame. There is more to this, but you have to put everything together, because if you look, we have another low here. It's not a swing, but it's another low, and we make an equal low. One of the other assets will have swept that low and made another SMT. Okay, if we investigate here exactly what I was saying, I'm going to open, I'm going to mark the open of this candle, and I'm going to also mark the open of this candle, just to prove the concept. Okay, so now we'll go down to a 1 minute. Get rid of this dot, and on a lower time frame, this will make a lot of sense to some of you, right? Because look what happens. Here's the initial soup, right? We also get a rejection wick here. Let me zoom in. We also get a rejection wick, and then what everybody does is they enter here, right? They enter here, and then they get stopped out. And this is one of the biggest factors. I don't know about you, Zeus, but this is one of the biggest questions I get. Why is it I've entered here, we've souped, we've took liquidity, and then we've come down? Okay, there's a number of reasons. First reason is, right, this candle needs to open low. Okay, the 9 o'clock candle needs to open low. We also need to have SMT, right? And I will say this until I'm blue in the face. No SMT, no trade. I get questions all the time saying, Rich, does your entry have SMT? Do you have SMT on this entry? Listen, if I don't get SMT, I am not entering any trade ever without SMT. It's that simple. No SMT.
Rich.
Yeah.
What does the T stand for in SMT? We know that SM stands for smart money. What do you think it stands for, the T?
The T stands for wow. Okay, so what I'm going to do now is I'm going to follow the crowd, and I'm going to say SMT stands for smart money tool or smart money technique. That's what everybody says.
Yes.
All the educators.
What do you know it says or means?
Oh, you really want me to spill it today, don't you? So, right. So
let's give the people something to remember.
So now Zeus is trying to destroy everything. I think at the moment, I think he's trying to destroy everybody and everything, because this information is just going to kill everybody. So, okay. Here we have a. Do you want me to do an example as well?
Yeah, let's do it, bro.
Okay. So here, right, we have an example of this trade. What I'll do. Okay, yeah, we'll go into the SMT thing straight away then. So if we look at this is a lower time frame market maker model here. Okay. We do have a larger market maker model also, but we'll concentrate on this one for now. If I was to say to you, right, that here we have the sell side of the curve, right, we have the original consolidation. Okay, the market maker isn't finished until the original consolidation's taken here. Okay, what we do know is this is the sell side of the curve and this is the buy side of the curve, but where everybody gets caught out is where the sell side of the curve and the buy side of the curve, where the sell side finishes and the buy side starts. Okay, and I'm going to give you proof of concept now, because when we have SMT here with another asset, for example, Nasdaq. When we have SMT here with another asset, from the very point that the SMT is shown, okay, which is right here. I'll zoom in a little bit. What can you see there now? Is that not clearly the sell side of the curve ending and the buy side of the curve, the very beginning of the buy side of the curve? Now, you hear people say time and price, right? And we've all seen the examples of people buying here and then going straight into drawdown by the time they get to here, compared to somebody who buys here and then goes straight into profit. And this is why. Okay, I believe SMT doesn't stand for smart money tool or smart money technique. It's clearly smart money time.
Gem.
And we get a lot of misconception about time and people trying to fractalize time, people using all different cycles and things like this, but true time is confirmed by SMT. Because is this the right time to trade anywhere on this side to go short? To go long, sorry. Anywhere here? Can you go long? No. But as soon as SMT is confirmed, can you go long? Yes.
And what do you see there inside this fractal when it comes to a very specific price pattern?
What's in every single... Okay, so let me clean this up then for the guys so that everyone can see what's going on. So everybody gets that principle. I'll let you go off and investigate. Now, I hope you understood what I was trying to explain about the open high, right, when you need to go low. And the reason everybody's getting stopped out here is because of you're not waiting for the candle to go open low. Yes, it does go a little bit higher, but you can ignore it. You just wait for the real move. This was only a few handles. This is the real manipulation, right? We can all anticipate 930 making the SMR, okay? The candle opens low to go high, flips the high, it flips the open, never to come back again. Now, what you need to understand is the algorithmic signature that I'm going on about being the unicorn model, right? But the true unicorn model, not a break of fair value gap like all the other donkeys on social media talk about, these educators that you're just wasting your time with, honestly. If you look here, here's the breaker, right? Now, we have the unicorn model right here, right? This is perfect for me. Yes, we don't get the BISI in the enter, but what we do get is the immediate retest here, which is perfect. I prefer these. Okay, I'm getting in on that all the time. Now, the real source comes here because everybody's missed this. Everybody's missed it, right? Think of the logic that I showed you with the candles open close, right? Bear with me. Here's the candle. Let's say, for example, this is a down candle, right? So this is a bearish candle. Guess what? There's a unicorn in this top wick. 100%. They may not look the same, they may not be as neat as this, they may not present themselves exactly the same as this. Every down candle has a unicorn in the upper wick. Okay? And the same for an up candle. Sorry guys, bear with me. Then for an up candle, every single open low to go long, guess what? Unicorn model in this lower wick. So we'll have a unicorn in here and we'll have a unicorn in here. Guaranteed. Maybe not always the same shape, size and entry pattern, but always, it's like a snowflake, okay? Everybody knows what a snowflake is, but every single snowflake is different to look at. Same here, look. If we look, we do have a unicorn in here, okay? There's one on the lower time frame. I won't use that to confuse some of the newer people. But what we can do is we can use this breaker if you wanted to. We could use the breaker lower down. They both work exactly the same. When we look at this model, here's the unicorn to go long. Every single wick has a unicorn model or some kind of unicorn model. And again, like Zeus says, this is an algorithmic signature, right, to tell you, right, that this is the move, this is the time, this is the price. Okay, so if you look here, price comes down, digs through the liquidity, but guess what? Here, yes, there's a breaker here on a lower time frame. We're not concerned with that. It's not significant. Okay, here there's no major breaker. Here we have a breaker. Okay, so we can keep an eye on this breaker. But wow, what happened then? So this breaker, as price is printing, we're keeping an eye on it, right? But look, this breaker never gets closed above. So as soon as this happens, we get this first rejection wick, right? We get this fake displacement. We get rejection wicks again here. Nothing closes above this high. That is the fake move. Price comes back down. Okay, we get another displacement candle. Nice. Okay, closes below the bodies. Forget the wicks. Closes below the bodies. This candle. We go down. I'm watching this breaker create as time's printing, as price is printing, right? As soon as I get this signature, I know that it's time. We have SMT, right? For those of you that don't know, SMT, the right SMT, forms in the first 30 minutes of the hourly candle. And we will have a unicorn. And this is all you need.
Rich, we of course did the Tabda live stream back in end of November.
Yes.
And that caused for a lot of, I'd say, eye-opening moments for a lot of people. But I think this masterclass right here will have exactly the same result, if not more.
Okay, good, good. And
I think many people will re-listen to this or have to re-listen because there are so many concepts that have been shared, like these small little gems that people likely listen over and then just forget about them. Well, My advice to those people would just be re-listen to this, because the amount of knowledge that is being shared right here, insane.
Yeah, nice one, mate. I didn't want to go too in depth. Obviously, there's a lot more to it, but the thing is, there's a lot of negativity online, mate. And what people don't understand is, we try to give out. Well, if like we give out as much as we can for free. Do you know what I mean? Like it's all free. This is information that if you run with it, you can be profitable tomorrow. If you listen to this video again, right? Add this on to all the knowledge that you've already got. Like, there's enough information here to go out and be profitable, and it's all free. Do you know what I mean? And you get people negative on social media. It's unbelievable, mate. But
Yeah, of course.
yeah, this is
Yeah, we of course can't guarantee that people become profitable, but it's just the knowledge. Like when you start seeing it, it repeats so many times.
yeah, mate. This is why people have to be vigilant, mate. Like, you can't. Everybody thinks, right, that going on the charts, trading in demo and not concentrating is the way forward, and it's not. I have calls with many people, and I tell them to stop trading, to stop demo trading, and physically watch price. You have to physically watch price. You have to watch it print. Like something as simple as this here, right? As we know, consolidations can't reverse, right? So we expand or manipulate in the other direction, right? We sweep this low, and as soon as we sweep this low, we notice that these candles do not close below. As soon as these candles don't close below, we can anticipate higher prices going back in the original direction. And it's these little things that people don't notice that make the big difference, and it's all because they're not looking, they're not watching, they're not paying attention, because they're too busy watching the price tag go up and down and worrying about a demo account, or thinking about the Holy Grail and Enigma and all these things that Enigma people aren't going to share with you anyway. ICT only knows the real Enigma. Yes, some of us do know the algorithm to a degree and to a high level, maybe not to ICT's level because that's his thing, but instead of worrying about everything else that's going on with trading, you need to concentrate on these important things, like everything we've gone over in this video, and actually watching how price prints. And like you advised me a year and a half ago, Zeus, reading price and understanding price action is key, mate.
That's it. And if you understand the framework that you're within, it's all just these small little things that you can add on top of that just give you a level of confidence that is unmatched, because you know that it should work this way. And if it doesn't, it's wrong. Your whole analysis is off. We were discussing this the other day, you remember, like people often question, well, what if I get stopped out? What if it does take out the protective low? Well, then you know that's not going to run how you think it's going to run.
Exactly. And what people miss is, look, I always reiterate this. Okay, so draw on liquidity, right? Higher time frame order flow and draw on liquidity, other than time, is one of the most important aspects of trading. Because if you know that price is going to go from A to B, right, or the low to OTE, all you've got to do is find an SMT anywhere in that leg, right, and it won't fail until the draw on liquidity's hit. It's that simple.
So you don't only look for SMTs inside of your smart money reversals?
Nope.
But also for your entries?
Also for my entries. Every entry, even on even on a unicorn model, will have SMT. I use what's called entry SMT. So for example, if we look at this entry model here, let me clear this up, we don't need all this now. If I was thinking of entering, most people would enter in this fair value gap here, right? They probably wouldn't even wait for this breaker, right? If I waited for the breaker, which would be the sensible option, okay, I would be looking for this. Okay, yes, I can show two options. I can show two options in one here, so let's do that. Let's get rid of that. If I was entering in this fair value gap here, for example, right, this candle and this candle on another asset, right, would have SMT, candle to candle SMT, what I call candle to candle entry SMT. So let's see if that is the case. It's not always. So this particular one does not. So we'll go down to the lower one. Okay, perfect. So if you look, this is ES, this is NQ, this is YM, right? If you were entering in this fair value gap, if we look, these make equal highs, right? So ES is the stronger asset to trade. Okay, when you see ES not take the high of the entry candle, wowzers, these guys are getting the money out of me today. Look, I'll zoom in so we can see this clearly. This is entry SMT. You won't hear anybody talking about entry SMT, right? NQ takes this high. This is why you get open gaps. This is why some people miss the move, right? And if you look, the SMT, Nasdaq takes the high, soups on the 1 minute. ES doesn't. You enter on ES. Okay, but you do not enter on this candle, right? Yes, sorry, you can't enter on this candle. This candle opened high. So because this candle opened high, you can enter. As soon as these two candles open high, the second one of these candles takes this high to the left into the fair value gap. This is a high probability turtle soup fractal on the 1 minute. It's no different on a higher time frame. Any turtle soup inside a fair value gap is high probability, right? Now here's the source. Because on ES this is a protected high, you can enter anywhere in this wick, or to be safe you can even wait for this candle to close and open and enter on this candle, because this candle also opens high. I would already be in here. I will show you now. I would probably be in by this level here by the time I've looked to double check what NQ is doing, right? Then, believe it or not, my stop loss would be here, because this is now a protected high. Or, as you see sometimes, I do not even have a stop loss. This is why. Okay, and if we look, this is going to make some people sick. We have a 0.75 handle stop loss. So on average, my stop losses are in between 1 handle and 3 handles.
The thing is, I think that many people think that, he doesn't have a stop on, so therefore he doesn't know what he's doing. It's quite the opposite. You know exactly what you're doing.
I know,
because you're monitoring how price is moving right there.
I'll prove it right now. So as you know, mate, because we are now in a sell program, right, the draw on liquidity, right, even if I don't zoom out, right, we can clearly see just from this aspect that the draw on liquidity is these equal lows here, right? I'm gonna show you guys now exactly what happens. Look, it's very, very simple and logical, right? It's just that all these idiots on Twitter and social media don't explain it to you, right? You enter here, this is a protected high, but I already know that this high is a protected high also. So when I got this displacement candle here, right, look, there's the BISI. This is the displacement candle. Once this displacement candle closes below this BISI, we can just enter here if you wanted to, right? I don't advise beginners to do that. I advise them to wait for the breaker, the retest of the breaker, because this is the algorithmic signature to say price will not go past this level, right? And I'll prove it in multiple ways in 2 seconds. But once this is in a sell program, right? Once we have proven time, right? So now this is the buy side of the curve, this is the sell side of the curve, right? Not just looking at the original consolidation, right? But just order flow in general. When price is coming down, look, standard procedure, this is standard turtle soup framework. We do not take the low here, look. For any of you that are vigilant, this is a turtle soup framework. It does this and repeats over and over and over and over again, right? How many times have you guys seen in my videos, right? I'm in a sell from the top, price comes all the way back up to OTE, then comes all the way back down, then takes liquidity. And it's what it does here. It repeats over and over and over again on all time frames. Okay, so it doesn't take here, but I'm confident because price cannot take this protected high until this drawn liquidity is hit, and the proof is right here. And yes, I'm going to get some idiots saying, oh, it's hindsight. Yes, it is hindsight right now, but I took this trade, I was in this trade, so I can comment on it, right? What you've
I think that's one of the main things you and I are so strong on when it comes to teaching people. It's like there are so many people out there that just speak about things in hindsight, but they can't execute it. They can't utilize the theories that they apply live, because it only works in hindsight, and they have 10,000 different theories for why price goes up and down. If you would study exactly what Rich and I are doing, it's always the same.
Yeah.
Always.
So,
and that shows application of knowledge.
So just a quick one here now as well, because look, we've hit the liquidity. Now we can take this high, this protected high, or this protected high, and that's exactly what it does. Look, price takes liquidity. Now it goes into a buy program, because guess what? Time is correct. Now we're in a sell program. Now we can take this high and this high, but we can't until we hit the liquidity. So when the liquidity is not hit, I already know that this is safe and this is safe, right? Now look at what I'm going to show you, because some people are going to say, yeah, but Rich, you didn't do OTE. That's because if it didn't do an OTE, that's because you don't understand your ranges, right? That's the only reason OTE doesn't work, right? So when we do what everybody does on social media and we go from the high to the low, oh, it didn't work, Rich, you're lying, you don't know what you're on about. No, mate, it's because your educator or the idiots that you're listening to don't know what they're on about. And now this is the range, this swing high to this swing low, and wow, look at the precision. It's unarguable. This is the range, this swing high to this swing low is the range that we are working in right now, not this range. This range is over unless we break this range and we close above. If these candles close above this range is high, this range is EQ, then I would pull the fib to this range, and then we would expect some kind of movement from this range. Now, to prove the whole theory again, what am I going to do? Okay, I'm going to pull the fib to this range low and watch this OTE react. It's the same. Look, see how we don't close above. Okay, we have one close above, one close below, that's fine. Again, it proves that we're not going higher. If one candle closes fully above and then the next candle closes fully above, two candles close above, then we're going to go higher. This is what reading price is. This is reading price. It's looking at how the candles react at specific levels at specific times. And this just repeats and repeats, and we see the same thing day in, day out, and nothing changes. It's identical.
I think that's a great way to end this masterclass. What do you think, Rich?
Mate, I think they've had way too much out of me.
I'm sure that they have a lovely Sunday after this.
And you
family time will be completely gone probably.
Yeah, and you wanted to just give it all away for free.
Mate, sometimes it's important to just do good
No, mate, that's
for others.
that's why I'm the way I am on Twitter, mate, and that's why, yes, sometimes I do advertise people that I believe in, which is only a handful. You being one of the main ones. That's the only way you can do it, mate. Look, you give as much away as you can for free, but at the end of the day, mate, we all can't just sit round helping everybody all day, every day, or we'd never get anything done. But again, to some of my followers out there and some of your followers, yes, we don't explain everything down to a T, because again, if we just give everything away, people wouldn't work for what they've got. People don't appreciate what they've got when it's given to them. So I'm still a big believer on giving people the information to run with, but then they still need to go out and do the hard work to prove it, to research themselves, like me and you had to, you know.
Yeah, of course. It's all about putting in the time and effort.
Yeah, for
That's
sure.
it. If people want to follow you, Rich, where's the best place that they can go to?
Yeah, Twitter. They can go to Twitter at Richthebull008. They can catch me there.
Yeah, it will be in the description of this recording as
Yeah.
well. And we'll also link you the recording of your Telegram, or the link of your Telegram channel, I'm sorry. Because if people type in your name, of course, on Telegram, there are a lot of scammers pretending to be you. And it's very important that people don't fall for that.
Yeah, exactly. Yeah,
I want to thank you for your time. I hope that everyone learned something from this from this webinar. I'm sure that at least one light bulb moment occurred, because man, so many gems were shared, and I think that we should all say thank you to Rich. So if you enjoyed this webinar, please reach out to us on Twitter. Just tag me and at Richthebull, and then we'll interact with you and appreciate you for your time.
Yeah, cheers, guys.
Is there anything else you would like to add to us?
No, mate, I just like to say thank you very much to everyone that takes the time to watch the video. Like you said before, I would watch it over and over again. You may pick up on some things that I said, and I hope everybody has a good weekend.
Perfect. Be safe, guys.